look, it was clearly a dovish hold from the BOJ, and I think the instant reaction you're going to see from the currency is potentially dollar yen retesting that weakness that it had a few weeks ago at 158, 159. I think it's about 157.80 as I speak. So that's not great if you're a yen bull. But thinking of the equity side, we still like equities. I mean, you've got the cheap currency benefits all those export-orientated companies in Japan. Japan is a cheaper way to play AI compared to, say, the US, where tech stocks are expensive. And finally, think to the second half of the year, to the point that you made, Japan, the BOJ have left open the idea of QT and increasing interest rates second half of the year. They might be doing that at the same time as the US is cutting rates. So that could potentially be finally bullish for the yen in the second half of the year.
What about the U.S.? I mean, of course, at the start of the year, people were expecting rate cut bonanza, and then there was a big letdown. But looking at some of the data points, the U.S.'s CPI, PPI, as well as the jobless claims that I just talked about, would that somehow change the story for you?
So yesterday's PPI was a pleasant surprise for us, as was the CPI, and the US Treasury auction went really well. And I think that's why you've seen this rally going into the back end of the week in both stocks and bonds. But we're not getting carried away. We think it's too early to call time on high for longer. And the reason is because of that growth data, that other side of the conundrum. You've got this tide of really strong data, whether it be NFPs comfortably above 200K, PMIs above 50, retail sales are remaining resilient. So we just think that data is too strong, and that's why you've seen the Fed take quite a cautious approach to its dot plot. And we think it's far too early to call time on high for longer yet.